Oh, good morning, everybody. Welcome back. Um, we'll get started here. We had a good um, call yesterday with Derek on his Clubhouse, and it was a lot of fun. And if anybody wants to pick up on any of those topics, that's a good idea. Also, I wanted to bring up that I didn't feel like we got much discussion out of the Top Traders Unplugged extravaganza with all six of us last week. So I started listening to that yesterday, and I just sort of jumped into the middle, and it was really I was really interested and I liked it. I liked what was being said. I did felt like I got a little aggressive a couple of times, and I was getting very confident. I think Richard does that to me. He makes me overconfident, so I started getting very opinionated and confident in my opinions. But that's a good thing to pick up on. And then, of course, we had all the tweets with George, and I think George is might be on, so that's good. And we can pick up on that good conversation, mostly between him and Richard on Twitter, which was a lot of good stuff. And I'm really interested in just seeing where that can go. And then also, Niels posted one of the questions on Twitter that he had asked us, and that took off like wildfire. And that was a pretty, maybe we've talked enough about that, but it was this idea of if given these choices of lots of systems, and I guess that means trend following and all kinds of systems, mean reversion, convergent, divergent, trend following, and other systems, and different parameter sets and different markets, what's your preference? More markets, the same trend following system, but more parameters, fewer markets, more systems, more parameters, or something like that. I think it got a little confused to me how the way we were answering that question. But anyways, I just wanted to mention that also I won my fantasy football this season. The season concluded last weekend, and it was a fair amount of luck, I suppose. And I've been playing fantasy football for maybe 6 or 7 years, and it's a good diversion, especially when you have to worry about the markets. And I can just turn it off for a while and screw around with fantasy football. But I would just say that I was very long term in nature, so I chose players who had a good long term track record, and I was very short. I was very hesitant to get rid of these players, with short-term performance. So, and then I was very systematic. I played the same group every week. I wanted to play the same group every week, and so unless there was injury, unless there was bye weeks, I tried my best to play the same players all the time. And so I tried to have the same sort of attitude about trading and fantasy. Is that systematic, long-term, large sample size, and try not to guess. I think trying to figure out who's going to perform the best week after week. You get rid of a player who's underperformed for a week or two, then he does great, and then you put him back in, he does poorly, that sort of thing. So it's the same way with the markets. I'm going to continue trading Cocoa. I'm not going to get it out of my portfolio. It's going to do fine one of these days. And so, but then I have played against people who were like day traders. They were short term and they did really well. So I think that maybe once again, the key is just to be consistent, stick with whatever method you're going to choose and go with it. So I thought you might be interested and now we're in the midst of fantasy hockey. Same thing. My team's doing great. So we'll see how that goes as well. So if anybody has anything they want to ask or talk about, please go ahead and take over.
Well, I just want to say Happy New Year for everyone I haven't spoken to before or after the New Year. Um, so good to be back. Good to get the ball rolling again.
Hey, hi Jerry. Hi everyone. Happy New Year for everyone. Glad to be here too. Hope 2022 will be better than 2021 for everyone. On this question about what's better, lots of systems, lots of markets, lots of parameters, I have a pretty specific question. Once you define that a new market is attend the prerequisites I mean, it's liquid enough. I don't know, whatever prerequisites you think are suitable. What's the process to include it in your systems for you guys?
Can I ask a follow-up question? What do you mean? How far does is it suitable? Because I mean, I really do have a process, but it's suitable doesn't really kind of define where in that process I might be.
Bruno, can you run that by us again?
I asked on this topic about when you have to choose between lots of systems or lots of markets or lots of parameters. You guys said that lots of markets is the number one priority. So my question is, when you decide that a market has it's qualified enough to be in the system, what's the process to include it? Do you wait for a new trade to come up, or you put on the position if the signals are already on? How do you think about this?
Yeah, that's interesting, Bruno, because the way I view outliers is that they're unpredictable in nature. So for me, I just make my system active. I don't care about the regime or whatever timing factors. I just simply make my system active and wait for that signal to trigger. That's as simple as it gets for me, because I tend to define what we are targeting as these non-predictable universal features of any liquid market, as opposed to trends that are not part of our sort of purview. So I see trends in multiple different forms. The ones we're particularly focusing on are these things termed outliers. But not all trends are outliers. There might be a segment of a mean reverting, cycle, or they might simply be a random feature. So these particular things that I'm targeting are these universal features found in any liquid market. So because therefore they're unpredictable and you can't time them, you put your system on, you just make your system active and just wait for that first signal to arrive and take that signal.
So I've been facing this recently because I decided to add a lot of stocks, and I've been going through and choosing, stocks that are sort of commodity based, and that will give me some, good diversification, and try to get to 150 or 200 markets, primarily, based upon adding single stocks. So a lot of these stocks are in big uptrends, and so when I add them to my list, I'm faced with this. This market has been long for 2 years or 1 year, and it's a pretty big uptrend. Administratively, I want to go ahead and put it in the process so the traders are familiar and ready. But I really don't want to put this trade on until the next unique, signal occurs. And so I run my approach, with computers, and I run it as sort of a theoretical system. So it pops up and says, "Oh, we're long this from 2 years ago." And so I don't really have a mechanism to say, well, we're going to buy it today. We're going to kind of give it um, our stop loss, and we'll get out, and we're going to kind of do it off the books, kind of off the system. We don't really try to do that too much. So I'm faced with the same issue where I'm not going to do these trades until, if they're long and have been long for a while, until they become a short or they go flat, and then it's live. But then some of them have been on for a week or two or a month or two, and there's small profits. Then I'll just go ahead and get in. So I'll follow the system as if I had done it on the original entry day. So unfortunately, let's say if I'm going to give it this system gives it a 4 ATR stop loss, this may turn into an 8 ATR stop loss, because I'm not going to get out until the system says, "Hey, get out." And so I'm running this theoretical system all the time that may not look a lot like the actual for some of the markets, but this is always an issue, when you add new markets, when do you want to add them? And I just decided to add all these new markets as soon as possible and just get everybody used to these new markets. But it is always an issue. I think that was your question.
Yeah, exactly. Sorry for the bad audio. Um, what I was thinking is that perhaps one way to add it is to add them as soon as possible, just like you guys said. But um, for this specific case of an old
I don't know about you, but you seem to have cut out, Bruno.
especially behind. So a way to alleviate this, attenuate this, is to, for only this single trade, put a stop loss based on your price entry and not the system stop, if that makes sense.
Yeah, I think that makes perfect sense. I've done all sorts of things. I have gone in and overridden the entry ATR, especially if the trade has gotten very volatile. So if it's gotten very volatile, but I think you're right. That's the thing to do. And even if it's gone a long ways, it probably hasn't gone 100, 200, 300 ATRs like some of these trades will do. And so you're sitting here saying, oh my, this is a trade that's been on for a while. It's a nice profit. It's made 20 ATRs. And, if I would have done that in a Tesla, I would have missed out on another 400 ATR profit. So it's like Richard said, you you don't know any, you're waiting for these outliers. They're pretty huge depending upon your look back. And then you're getting kind of squeamish that, oh, it's already gone a long ways. And then later you say, oh, it didn't really go a long ways. This is a long ways, and I kind of missed it. So I think that's exactly what you should do. Blend the theoretical and do the best you can. Put the trade on, give it a stop loss. And for me, that would just mean I would have to sort of um, do it outside of my programmed system and write it down and keep telling my traders, don't get out of it. Here's this new level to get out of this particular market. Don't pay attention to what the system is doing.
Just one thing as well, Bruno. Just to be aware that when you start off these diversified portfolios, it's taken me, for instance, between 1 and 2 years for it to settle down into something that I'm comfortable with. So initially, in that first 2 years, I cop drawdowns simply because it takes a while to get hold of these outliers, and so the majority of your trades that you take to start off when you under inception of your portfolio, they're losses. So you build up this large sequence of losses, or maybe small wins, etc. Small wins, small losses, etc. But there's this inevitable drawdown build before you start catching hold of these outliers, and some of them you might be holding 2 or 3 years. But you'll find that after about 2 years, you'll start coming out of drawdown, and I think there's this very natural sort of thing that happens with a diversified portfolio, that it is inevitable that you go into drawdowns as soon as you start off. So don't lose heart when you start off with these trend following models. I think Jerry might have been fortunate in the 1980s when he started off with Chesapeake that these outliers were just booming, and he might not have experienced that. But certainly in today's environment, if you start off these things, there is this inevitable drawdown build before your systems get traction, if you know what I mean.
That's good advice. Thanks a lot, Richard. This group is just really, really important. Believe me. Thank you.
Hi to everyone. Very happy to be here as always. First time in this year. And I want to say that about this topic that, of course, a drawdown in this situation, of course, it's a part of our trading programs, and it's okay, I think. Even such in a such situation, I think we, like Jerry said, we must not pay attention much to the drawdowns, because it only makes us more uncomfortable than it is.
Jerry, echoing the what you were mentioning with stocks, I'm just curious, do you look at ETFs within this world as well? And really, if so, that's something that I'm doing. And what I'm finding is that there's a lot of correlation across ETFs in seemingly uncorrelated sectors. And that's something I'm trying to figure out what I should think about that with regards to timing on execution. A lot of ETFs seem to go off at similar times, even though they may be conceptually uncorrelated.
Yeah, I've talked about trading single stocks a lot, and I've sort of taunted CTAs and tried to shame them into agreeing that they should trade single stocks and grab that diversification and get away from these indices. And I've said, like, well, it's a daunting task. If you want to trade all the commodity futures, then trade them. We know where they are, we know the list, and we know which ones we can access in the volumes and open interest. And same with the currencies and the bond markets; they're all there. And but then you say, well, what about stocks? Well, it's just really freaks me out that I'm going to go from 20 or 30 stock future indices. Now you're telling me do whatever you want. You can choose 20 or 30 or 40 or 50 individual stocks. It's too many to choose from. So you get paralyzed. And but one of the ways that I have done it, is I have focused on these ETFs. And it seems that these ETF companies are out there just generating these new ETFs with all these different ideas and sectors. Psychedelic drugs is one I found the other day. And so I don't want to trade the ETFs because that's like an index. I want to look inside. I want to use this ETF universe to help me do my job to identify diversifying stocks. And then so I'll scour the ETFs. Then I'll go inside and look at the holdings of the ETFs. And then I'll start looking at the individual stocks and researching them and trying to find a pure play on something. It's kind of like you don't want to trade an index or an ETF itself because there's too much diversification in there. And we don't want diversification in the market itself. We want a small company or medium-sized company has a single product that's going to dominate, for good or bad, the performance of this stock. And we'll take care of the diversification with all the markets we trade. But we don't want the company itself necessarily to be too diversified. So this has sort of been my theory and the way I'm proceeding. And then I look at the 13 Fs that big traders file that shows all of their holdings of stocks on a quarterly basis. And a lot of them trade these ETFs, these different sector and these different types of ETFs, rare earth stocks, rare earth minerals and metals. Yeah. And so this is another great one, right? We can't get this in the futures market. So I can't get Baltic dry shipping futures, but there's an ETF for it. So that is one I'll probably will trade the ETF of. But for the most part, I'm trying to uh, figure a way to sort this world of stocks down to 40 or 50 stocks that are really unique in some ways. And if you look at a lot of the stocks, especially the ones in my portfolio, so many of them have been in downtrends for a long time. So that's a good signal that you've got a good diversified portfolio of stocks, is that they don't look like the S&P.
I like this idea, but I want to say that uh, in all cases, anyway, it's a stocks. So we must not have very big amount of stocks in our portfolio. So I think it's okay. I accept that it's okay to have maybe 30% or maybe even 35% of our portfolio stock is a stock portfolio because of the diversification benefits of different stocks. But we must remember that stocks are financial instruments, and as I say always, if crisis begin, all these stocks will go to zero. So we must have good uh, allocation to commodities in our portfolio.
Jerry, are you using, by the sounds of it, it looks like you're using something like idiosyncratic volatility to see if a stock is eligible for being added to your universe is that right? So basically, like each stock has its returns driven by either systematic vol for the market or some idiosyncratic reason, and you're looking for high percent of idiosyncratic vol. Is that how you're picking things?
No, I'm just looking at the name of the company and what it does, and to see if it um, does something unique. And like I said, I don't want the company to be too large and too diversified within itself. And then I look at the chart, and I don't want to sit around and do my research and say, well, I've got all these very unique stocks. There's a company out there that's fairly large that's called Oatly, and it makes oat milk. I mean, how crazy is that, right? So that's probably a good candidate for me, right? And so when I get all of these stocks together and I look at the charts, oh, they're all in an uptrend. They all look like the S&P. Oh no, that's no good, right? I haven't done a very good job. But that's not the case. If you step outside of the big stocks in the U.S., there's a lot of fun things and a lot of interesting ideas going on in companies that will give you some unique uh, chart patterns, or and actually improve your diversification. And I can't go from 100 futures markets to 200 markets without using some equities. Um, and I think Oleg keeps saying going to zero. I think it's going to one, Oleg. Although if you trade too many stocks, you might go to zero. I agree with that. But I do think he's right about that. And that is what I was getting at yesterday. That if you come in with too many stocks, too many long stocks, too many stocks that are similar, what are you going to do when the stock market goes down? Well, my opinion is it's too late. Don't come in like that. Don't have a portfolio where everything is long, or you have too many equities and they're all long, because you need to have this balanced portfolio, like he was saying, with commodities, currencies, bonds, and stocks. And hopefully, fingers crossed, that you have a couple units of longs, a couple units of shorts every day. Every day. So when you come in every day, your defenses are up, your opportunities are there, and your defenses are up. But coming in every day with too many of one sector going the same way, or like in 2020 in February, I feel like all the trends were up. It wasn't just that stocks went to one, so did commodities and currencies and bonds. We got crushed, not because we had too many stocks, it was because we got crushed to the degree that we had too many positions on, or the amount of positions and the risk that we had on. Thus, that was the last time I overrode my systems with what we used to call a money management cutback, the cutback rule, to reduce positions um, when you're losing money very fast.
Thanks. That makes sense. And just a follow up on, I've been hearing in this clubhouse room a lot about diversification and adding new markets. How do you guys measure your degree of diversification? Like, is this something that you use pairwise correlation? Do you use some Herfindahl index, PCA analysis? Or what is the technique, the quant technique that you use to kind of determine whether the addition of an extra market is worthwhile in the portfolio?
For me, I use risk metrics like the serenity ratio or the MAR ratio at the portfolio level. So the way I do my diversification is at a return stream level for each individual system. So let's say I'm trading corn. I might have 3 different systems. They generate 3 different return streams for corn. And then when I compile my portfolio, I have all of these return streams consolidating at the portfolio level, and then I use a global metric such as MAR or the serenity ratio, and a mapping function. So if you could imagine it, it looks like sort of all of these strings of spaghetti that over a 30-year time frame that sort of consolidate into a portfolio. And if you look at how the return streams all work together, Where are there times where you get positive correlation in those return streams that's beneficial? Where do you get positive, adverse correlation, which is detrimental? You pick that up with the serenity ratio or the MAR ratio as a method to basically optimize your portfolio based on your level of diversification. At least that's how I do it.
I have
I
a
would
similar approach, I think, to some of the tools that you mentioned. Pairwise correlation is first and number one. Then also looking at scenario analysis using that and kind of the average general correlations across the matrix. It's not exactly how you're supposed to do it, but it's a quick rough guess that you could do in a Python notebook in like 30 seconds. The other things that PCA can also be used. But I think that in particular to trend following, and this goes back to kind of like you can have highly correlated markets, and if you are trying to catch that trend, certain things might fail to launch, although they have similar correlations or similar correlation profiles. I think the example that's always used is like Brent versus WTI. So it does increase your breadth, even though you have correlated markets. And then again, when you're putting things through the transform of your system, that decreases correlation. So, I don't use the MAR or anything like that, but I do look at the differences in my trade statistics and performance metrics to see if adding this additional market did give me any lift. Although when you get to larger size portfolios, you don't really see any statistical change. Like it's going to be very hard to say like adding this one market if you only have 10 or 20 versus adding this one market if you have 75 or 100. It's really not going to move the needle. And then I will just probably opt to just add it because it doesn't have like so much overhead cost. And also adding, we also look at kind of the cost of it as well as how frequently we're going to trade. But just from a purely correlation pairwise standpoint, that's pretty much my workflow.
Yeah, I'd like to second this point of from Derek. More than the correlation between the assets, the returns from the assets, you should look at the correlation of the return streams that they produce in your system. And apart from that, what you're interested in is in how this benefits your portfolio. So what Derek says that look at the um, return metrics on your portfolio and see how it enhances or deteriorates when you increase new markets is paramount. It's much more, I think it's much more important than look at the correlation themselves. And another point I'd like to make is uh, you when you have convergent systems, you have one reason to add new markets, and that's to protect your portfolio from significant drawdowns. You're hoping that when a market goes down too much, another one that's not related to it will protect your equity curve. But from a divergent system point of view, it's not that much. It's not that same reason. What you're looking at is for a different market to develop into a new outlier which you can benefit. And from this perspective, it doesn't really matter what's the correlation in the past. You're just interested in not taking things that are entirely equal. But as long as they're a little bit different, it can develop into a new outlier that your system will benefit from.
Hi, it's George. Thanks for including me, guys. Stan Druckenmiller says that diversification is the stupidest idea he's ever heard of, and that he thinks that to get great returns, you need to bet everything, basically bet the farm. That's what he sees by studying, what he considers the greats. So that'd be Buffett or Icahn or whoever it may be. So I'm just curious what people's thoughts are on that. I mean, I know it's a different style from trend following, robust trend following, but it seems interesting that there's such dichotomous views on the topic. I wondered if anybody had any thoughts.
George, you should listen to the Top Traders Unplugged episode in last year's June with Jerry. I think Jerry talked about this this way of thinking and Druckenmiller there, and it was fun and educative.
Yeah, I think it's. I mean, I've talked about this a lot. I think it's the best I can understand is that if you're trading a systematic approach, let's say it could be more than just trend following, but since I don't know any other, I'm not really well versed in anything except trend following, so I'll just stick to trend following. See, I think with trend followers, um, we're trading this systematic approach, and we're trading all the markets the same way. We're doing this big back test with this large sample size. We're treating the longs and shorts the same, every market the same, with this system and these rules. And then we come forward and say, okay, this is my system. The expectation is X, and we don't drill down into each market or sector and say, well, the expectation of this market is this, and the expectation of another market is different. No, all the markets, it's one big thing. We can cover up the name of the market, and we're going to trade them all the same way. And so our expectation per trade is the same. Our expected win and loss are the same, like a blackjack table, if we're following these rules. And the, the only thing diversification does is smooth out our returns a bit. But as Bruno said, the big thing about diversification is it helps us, it broadens our net at finding the big outliers. So we don't have our best 10 ideas like a fundamental non-systematic person might have, who if maybe they're successful, of course they're successful, and maybe their idea number 10, they're very hesitant to trade idea 10 because it's not as good as 1 and 2. 2 is not as good as 1, but for us they're all the same. And so I think um, there should not be skepticism, because there are a lot of people who are wealthy trend followers, and they stand right next to the wealthy people who are fundamental stock traders who do rank their ideas. We just sort of say, yeah, I don't want to be in that game. I like the math game. I like not thinking that I can predict. I don't want to predict. There's a lot of people who predict well for a while, then the prediction skills evaporate. And there's a handful that don't. And especially for me, um, I think that implementing this type of strategy and these type of rules this particular way, it gives me a overwhelming chance of success in life, where I think it's more rare. The Druckenmillers and the Buffetts of the world, it's a more rare thing than a bunch of us picking up trend following and trading all these markets in a systematic rules-based way. So I think that's kind of where the rub is, that diversification certainly has never hurt the trend followers, but maybe it does hurt the other styles.
Yeah, that's a
Yeah,
good point. And George, I'd just add to that, just saying that I think trend following itself offers a process that anyone can deploy. But something like Soros or something like Druckenmiller, someone like Buffett, they're using expert skills or knowledge acquired that might not be readily available to all market participants. But at least this process that we offer in trend following is a process that anybody can adopt, provided they've got sufficient capital, provided they know how to diversify, provided they know how to apply small bets and not over leverage their portfolio. So to me, it's there are two different philosophies. One is sort of where you view uncertainty as has a priority in how you address the markets, and that's what I believe trend followers do, versus those that are more like engineers who are looking at predictive certainty and looking at expert knowledge, etc. So if you do have that expert knowledge, or it's almost like insider trading, you would concentrate your bet towards that particular ideology. However, where you don't have that level of expertise, I think you've got to look at a process as opposed to a level of expertise to sort of allow you to survive in these hostile market regimes.
By the way, I think that we theoretically, it's maybe more joke, but we can theoretically also say that we are predictors because, in fact, when we see the trend, um, there is maybe some level of prediction that it will be highest. It will continue, but it's not our philosophy. It's not our way. As for me, I have chosen my way and my philosophy. So, and if we are talking about macro guys, they can say about some stocks. I'm not an expert in this field. I'm a transform trader, as you know, but I think that macro guy can say a lot of different things, a lot of different statistics, indexes, or his thoughts. But in fact, that company had a very good period in 5 years. I can look at a chart without knowing all this stuff and say, "Oh, this company have a good time, previous 5 years," but I don't know what will be in a year next year. I don't know the situation. And macro guy can say, "I know the situation because it was 5 years. It was very good. It was okay, and it will be." But I don't have such certain because our life is uncertain thing. Our world is uncertain. So we take a lot of different markets and use algorithm, and it's proven by centuries, I think. So I'm 100% systematic trend follower.
As we think about that diversification and risk management and go back to those back tests, I'm just curious what the thoughts are with adding instruments and adding diversification. So, Jerry, you talked about adding different stocks that could provide potentially outlier moves that aren't met in the futures or commodity space. You find something, you find a rare earth, outlier stock, you think it's interesting, you want to apply a model to it. Obviously, then that's going to get allocated capital that wasn't thought of in the back test, and you add a different component here and a different component there, and all of a sudden you're trading instruments that deviate from the back test, and that's something I've struggled with, how to comprehend and make decisions that are not systematic with regards to adding or removing from a portfolio.
Oh, very good question. Yeah, and that's I have an answer for everything. It may not be a good one, but I've thought about all these things, and yeah, and so this is just another reason I don't. Um, I have to look at these back tests with skepticism. And then this back test requirement that you bring up, which is totally reasonable. Now, this is going to stop me from adding more markets. No, 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 no. So that's what's going to give. The back test is going to give then, but not the quest for new markets and more outliers and more diversification and letting profits run with 300 markets or 200 markets looks a lot different than letting profits run with a long-term system with 50 markets, right? So this is why in the back test, I pay attention to, I don't pay attention to the equity stats as nearly like I would pay attention to the trade stats. So my average win, my average loss, my win percentage, my win-loss ratio, and you just start running this over hundreds and hundreds of markets and stocks and going back 30 and 40 years, and you start acquiring, oh, I see, these systems, these strategies with these parameters, they get this sort of average trade. This is what I'm going to expect in the future. Not only is that allows you to add markets you've never traded before, or markets that just have basically started a year ago because they were an IPO and it's a unique company. It's Beyond Meat, which is I added Beyond Meat, and because I believe that if you do this back test on all of these different markets, the expectation of Beyond Meat will look like the expectation of the group of all of the trades that I've looked at. So I just throw it right in there. And I don't want to be beholden to a good looking back test and say to myself, oh, look how good that thing looks. Now let's proceed in the future. No, my mentality is, thank you very much. I appreciate that information. It could get a lot worse. I'm going to trade a certain level, a certain risk budget, and that looks like, based upon the back test and the trade stats, that I can live with it. It's not going to be too risky, but get ready for that cutback. Get ready for February of 2020 because, that wasn't in the back test. We need to reduce risk quickly. I was wrong. I traded a bit too large for my liking, so I'm going to have to readjust. And so I think, you do not want to be limited, um, and have any sort of back test with limited data, especially, allow you to not continue to add more markets.
Something to keep in mind as well in relation to your back test is if we can accept the principle that we want to diversify as far and as wide as we possibly can, hunting for these outliers, then imagine if you did a back test over a 30-year period using, say, a diversified portfolio of, say, 50 markets. You do your back test and it produces this wonderful back test. What you do is you don't look at the back test as far as its smoothness or how wonderful it is. What you then say is, all right, where is the risk weakness in that back test? Where do those 50 markets suddenly become, adversely correlated to sort of produce a significant detrimental drawdown? If that's the case, you need to then choose a different bunch of markets to always look at how do you mitigate the risk events in that portfolio. So what I've found is that if I did a back test of 50 markets and I got a superb back test, then what I'd say is, all right, now let's add 100 markets or 100 return streams instead of 50, and let's see if by reducing my bet size for each of those markets, let's see if that produces if that compromises my portfolio with risk weakness by adding 100 markets as opposed to 50. And through that process, you start realizing that, all right, if I put a cluster of equities into this back test, this does produce this adverse correlation during market crisis events, and therefore you say, well, therefore I've got to look at more uncorrelated markets to lift my level of diversification up to 100. And as you do this, your back test is a method to basically allow you to continuously test to build your diversification with as small a bet size as you can to squeeze in as much diversification of uncorrelated return streams, provided there is not that risk weakness signature in that back test. Once you've done that, then you know that I've got a very diverse portfolio. It hasn't exhibited this risk weakness over 30 years of extensive data over all of these different return streams. I'm fairly confident it's managing risk well. I know that all of my systems have unlimited upside potential because there is no profit target adopted with those systems, because I let my profits run for every single one of those return streams. So I know that worst case scenario, I've got a robust portfolio that's got huge upside potential and the ability to, find these outliers far and wide wherever they may exist.
Stemming off that, do you then think of $1 and Beyond Meat of risk as $1 of, say, crude futures? And when you're thinking of your portfolio, applying those evenly?
ATR based.
Definitely ATR based, yep.
But so ATRs being this, all things being equal, the instrument receives the
Yeah,
amount of risk that the
in
model
your
calls
back
for.
test, just use an ATR based measure, and let's say you apply a standard risk bet for every single trade in your back test. Let's say it's $100. That's your maximum risk exposure using ATR. So your ATR technique will normalize that risk so that every single bet of that sequence in that back test is the same dollar risk bet. So it's adjusted for volatility across whatever market or whatever instrument you trade. Once you've done that with your once you've done that at the portfolio level using a fixed dollar risk using ATR, you know quite comfortably then that you might want to slowly compound it. When you go live or into a live account, you might slowly compound it over the course of time. But I wouldn't be sort of integrating compounding into your back testing, because that's sort of adding vagary to that risk weakness, because leverage is a very important thing you want to exclude from your back test, because with increased position size from compounding, that definitely sort of gives a muddy picture of the risk weakness. So at the backtest level, standard risk bet, ATR based technique to make sure that your adverse risk exposure in that portfolio is as limited as possible and you're as diverse as possible. And then from there, once you're happy with that and you go live, you can start using a soft compounding technique, based on that.
Something I've struggled with on the ATR, and I'm curious if this is something people have thought about, is whether or not to apply a different length of the ATR to a different instrument. So if let's just say crude tends to trend long and slow, maybe a 100-period ATR is more appropriate than a Beyond Meat, which is extremely volatile. And maybe you're thinking about a 30-day ATR on that based on the beta of the underlying instrument, or having some type of function that ties to ATR to determine what an actual ATR measurement would be.
Yeah, I don't do that because I try to normalize everything. So I use a 25-period ATR, a daily ATR look back for my ATR. I don't sort of have different ATRs for my different markets, because I'm trying to normalize it all in terms of a fixed dollar risk at any point in time.
I
I would
see a
be
lot of danger in that specifically, because volatility is different, right? We know that it clusters and then it breaks. And so how are you going to determine the multiple regimes, right? And then you're not going to have enough data for when a single instrument changes regime, but also how all of your systems across all of your instruments are also going to change regime. That's going to hit a lot of risk. And I've been waiting in line, so I will go back to George's quickly comment, and I will do the devil's advocate because I think that it's important. I do believe what everybody said about that is that it's not replicatable. That's true. But the macro guys find a lot of convexity, and what they're doing is they are finding specific situations where the world must converge to their trading view, and they don't take small losses. I think Drunken Miller was with Soros. It's like you don't see them breaking every central bank. There's one specific opportunity set where they can take advantage. They make a lot of money in the returns for themselves, but they've also lost a lot of money for their clients taking these bets when they don't converge. If I can remember, it's probably like more than $3 billion they've lost clients in themselves. They also said it was stressing them out. So not only not replicatable, but because of how the opportunity sets are given, they might be in target poor environments for a very long time and lose a lot of money for clients. Thanks.
Can I comment on that? Just the 3 billion I think was divided by 9 billion, so it'd be about 33%. Drunken Miller said in an interview that it was the wrong thing to do. And if you look at most trend followers, a lot of them, the best have 30% drawdowns, but a lot of them have 50% drawdowns. So if you normalize the drawdowns as opposed to dollars, I mean, you could argue the same thing happens with trend followers. And you say, well, yeah, trend followers keep losses small, and they do, except for when it comes to the actual trend following strategy, right? So there's what I've seen is a buy and hold mentality on trend following. There is no trend following applied to the actual trend following system, which is interesting to me, for whatever that's worth. So
I haven't looked at the performance of Drunken Miller's firm, but certainly with Berkshire Hathaway I have. And when you compare pound for pound over a very long term, performance series, say 30 years or so, like with Buffett, I do find that there is an entire class of trend followers that outperform Buffett in terms of drawdown. Like Buffett, I think, has produced two plus 55% drawdowns over his period of term, so over the past 30 years or so. But I have found that there's about 25 to 30 trend following funds that have had a far lower drawdown and comparable CAGR to Buffett. So this is where the problem arises. I can see a lot of trend followers or group or a class of trend followers achieving very solid long-term performance returns, but I only see a handful of experts like Buffett, Soros, Druckenmiller, or whatever, who can deliver these outstanding long-term performance returns. And so there's definitely this level of skill that they're applying, which we're not privy to or whatever. And it might be because they've got these very large research houses backing them or whatever. It's certainly for an individual like me, who's a retail trader. I need a process to be able to deliver those returns, as opposed to try and compete head on with these massive quant houses or research houses or whatever. So, it's a game that I can play over the long term without having to be, a PhD.
By the way, near 1 month ago, we were talking on a similar topic, and one guy, I said that I don't see being repeatable for me personally such methods like guys methods and so on and so forth. And one guy, I don't remember exactly who he is, uh, said that for him, and I said yes, maybe it's repeatable for you, I don't know, but it's certainly not repeatable for me, because I don't want to repeat it. I don't want to know the science, because I don't need this. I have my own personal way.
Those are interesting points, guys. So I think it's hard to argue with Richard's point of trend following over time. More people can do it and get MAR ratios, which is compound annual growth rate divided by drawdown, of about 0.3, which tends to be better than Buffett or others. But that raises another question to me, which is, why doesn't a lot more money go to trend following? The returns are better. It's proven over 50 years of real returns or thereabouts. So why don't allocators make this 25, 50% of their portfolios? I'd love to hear people's thoughts on that.
Well, it's because we can't offer, instantaneous success. So, convergent methods do, because, the whole basis of a convergent method is you are looking at a predictable market cycle or whatever, such as mean reversion, and then when you apply your system, you are immediately jumping on board that cycle. So therefore you expect your equity curve to immediately start performing as soon as you take your system live into the environment. But trend following is targeting the tails of the distribution of market returns. And that's a waiting game. That's where you turn your systems on, but you might be waiting 2 years, 3 years before those environments occur. So you can't offer that immediate guarantee, that immediate cash flow that investors are looking at. And what an investor will therefore do is say, when they start seeing you going into drawdown, you've got a volatile sort of equity curve, they start thinking you're underperforming. But that's actually a natural symptom associated with our predictive patient method. It's an inevitable requirement that we have these volatile equity curves. We can't offer these smooth ascending equity curves. And that's why when you assess the fund management industry, you see that about 95% of fund managers offer convergent solutions. There's only about 5% of them that offer the divergent solutions. And I think it's because we can't guarantee this immediate success. So therefore people think we're underperforming.
What's a convergent solution?
Well, a convergent solution is what I refer to as long GDP solutions, carry trade, so many different types of risk premium attack what I call convergence. In other words, a convergent method is one that looks at a historical data set and associates a notion of a mean or a median associated with that historical data set. And it therefore looks to where current price is now. And if it has had an excursion away from that historic average or that historic mean, they believe in a predictive manner that price will revert back to that intrinsic value or that median value. So fundamental value investors use convergent methods. They have this notion of what they call an intrinsic value based on their data analysis of their samples. and they look where price is now and they say it's overvalued or undervalued in relation to that intrinsic value, and it will mean revert back to that intrinsic value. So, but a divergent trader is based on this principle that, it's a forward-looking stance as opposed to a backward-looking stance. Convergence looks back to the history and says, where is the median, the mean, the mode, where is the data distribution? But a divergent trader is basing their assumption that markets want to diverge away from that historic mean or that median or that mode, and that will diverge away. So it's more it's based on a principle that markets during periods of uncertainty diverge away from their center point or their mean value, and that's where we are targeting returns from. We're targeting it from the tail regions of the market distribution of returns, as opposed to the bulk of the distribution of returns, which is more normally distributed, and that's where convergence tends to be very successful.
I also think the issue of why trend following isn't as widely followed is because I think it's quite difficult to get and then maintain investor confidence. Because when you're thinking about the convergent styles that Rich just mentioned, if a business isn't performing well and that's reflected in the share price, then it's easier to explain to investors which aspects of the business aren't performing, and it's also easier to kind of contextualize that in the broader kind of macro conditions. But with trend following, it's a bit harder to say this is how it is. We don't know when the next outlier is going to come from, and so I assume. I mean, you'd have to have an investor on board who understands trend following as a philosophy, and who's able to kind of accept the drawdowns, which is probably easier to accept in, let's say, kind of the school of value investing.
I think that is it hit on something, and also Mark Brzezinski. I hope I pronounced that right.
Call him Izzy. I know Izzy. G'day, mate.
Hi, Rich.
So one of it is narrative. That's really important to investors, and that's why you get rock star traders like your Sources, your Drunken Millers. They have a great narrative. Your Buffetts, they're the rock stars of trading. They will always have a following. They're able to raise big money, lose big money, and come back again and continue to raise. Tiger Cubs, it's like the children of these guys. Even I get some of that aura. And then again, to explain away losses is really easy because they have a story for their trade. And then if it went wrong, they're able to explain why. And then, like, that seems like a good story, so I can accept that. Here's some more money. Let's try again. With trend following, it's not so clear. And also, if it's so easy that everyone can do it, which is kind of what, the turtles and what we preach here, why am I paying you to do it? I can do it by myself. And then you get the rise of the European trend followers, and they complicate it so that now it's like, hey, we have trend following. It's sexier. It's got more glitz and glamour, and then they end up raising more money. And that they sold a different story. They sold a story of, we're stabilizing this thing. We have more PhDs. We're able to smooth out these returns by using these other techniques. We're able to mix additional strategies, and some of them are convergent for sure. Although we have heard that potentially some are moving back to the traditional trend zone, but they're always going to have that convergent mix, and that allows them to stabilize and say, "Oh, look, we've got 10,000 strategies doing these things," and then that's their narrative. So I do think that traditional classic trend following has a narrative issue, and I know this is a problem because I face this when I'm trying to get in front of clients or trying to explain things. So it's definitely something I've been paying a lot of attention to. And especially as a small manager, generating my own specific glitz and glamour, so to say, that doesn't break the golden rules of a divergent trader is really important, because otherwise you won't attract it all. The idea that we have these replicators out there to do what they're doing, or the rules of the turtles is out there. People can back test in Excel or Python or whatever. It's so easy, that no real money investor is really considering, like, yeah, I should really pay for this guy to do this thing for the next 30 years. um, and then how do you classify them? There's so many different types: short term, long term, people trade focusing different things. And then if you get a drawdown, I mean, the story is really hard. It's just like the system wasn't working. Well, you should change your system. Something is broken. You need to update. And you tell them, no, actually, I want to keep it exactly the same. That doesn't go over that well.
I agree with all of that. I think that when you get down to it and people experience it and you explain it to them, they're like, "What the heck? You want me to wait and wait for these outliers?" And then when you get the outlier, it's going to be very volatile, and then you're going to have all this profit built up eventually, finally, and then you're going to be willing to give a lot of it back and tell me that it's closed trade and open trade and it really isn't a loss, it's just volatility. And you're like, you're crazy. And you're asking me to do this in these commodity markets when all of my friends are invested in equities and bonds, 60/40, 401k crap. And then, oh, and then you have the smart guys come in the 90s and 2000s and say, wait, we can get rid of all of that. We will not hold on to these trades. We will not let them get crazy volatile. We will scale them back. We'll vol target. We will, of course, we are the only CTA category that needs to add another category for us to be acceptable. We need to mix our trend with convergence strategies as well to smooth everything out. And then at the end of the day, when the markets are really good, like the past 2 years, uh, very few of the large firms have these awesome returns because they had already practiced taking small profits and being very concerned with volatility and smoothness over capturing the big outliers, regardless of their volatility. And so I think to a large degree, um, the opportunities out there for investors are with firms who have never really practiced the type of trend following that scares the pants off people because that's not the way to maximize your AUM.
One of the interesting things is that, we all remember market crises when we're in them. So we had a crisis in '87, we had a crisis in 2000, we had a crisis in 2008. We had a big downturn in 2020. So, but there's almost like an entire generation of traders that can exist between those crisis points that never have faced these crisis periods. And during these crisis periods, we typically find this is where the classic trend followers absolutely clean up, 100%, returns for that particular year or whatever. If I go back to 1987 or I go back to 2008, you see some stunning performance returns of classic trend followers. But um, people have short memories and they can't remember the last crisis. So they always discount our abilities until a crisis occurs. And as soon as the crisis occurs, of course, trend following suddenly becomes incredibly popular again. But then after 1 or 2 years, market starts creeping up. It starts doing these long, protracted periods of bullish sort of runs. And a whole generation of traders are created who are targeting that particular sort of period between crisis events who've never experienced these crises. And so the market participation suddenly gets dominant in this sort of easy money because markets are always going up. And so it's sort of like an inevitable sort of consequence that we're going to be facing until we do improve the narrative. And I agree with Derek. I think we've seriously got to lift our narrative to explain this to traders.
Just to jump back in, thanks for all that. So summarizing, it seems like, because I imagine this would be beneficial to everybody who wants to raise money as a trend follower. The reasons more money doesn't go to the space is the no narrative, meaning we have no narrative. That's our narrative. Long drawdowns, volatile returns, giving back a lot of unrealized gains in hopes that that'll go up tenfold more. Tail betting, and then the do-it-yourself mentality of investors, which personally I think is not correct. I think it's hard to find people that can stick to systems and like Jerry was saying a few minutes ago, systems change, right? I mean, you look at your back test, you see what happens in reality, you change it. So how do people do that? I think there's a discretionary element to trend. But anyway, that's just quick summary. I guess the question would be, how do you change that? And to your point, Richard, maybe you teach people more, but then like humans hate uncertainty and they like stories. So how do you contend with that? Can you?
George, I think that there's a movement underway. We've got the likes of Ole Peters, we've got the likes of Nassim Taleb, we've got the likes of Brian Arthur, we've got the likes of Jean Pierre Bichard. Complexity theory. I think this is something that sort of jumped out at us from about 1980s, where it was in its infancy, and now it's developing a lot of steam. And I think when we start understanding these markets as complex adaptive systems, as opposed to the traditional way of viewing these markets as sort of normally distributed, Markowitz, Sharp, all of these sort of very influential sort of economic theories that have tried to explain the market, which have been successful for the bulk of the distribution, but it's not successful when we're looking at crisis events or tail regions. So when this narrative improves, that people can start understanding complexity theory, I think there will be a greater sort of attraction towards these trend following programs, because I think we've sort of had a, by expressing them as very simple programs, or anyone can do it, I don't think that does us any service. I think it therefore means that for an investor who's wanting to allocate money, they don't want it to go towards some dumb bunny who's got a very simple strategy. They want to put it in the hands of someone who's skilled, who's got a level of expertise that they can't replicate. So I think we've got to up the narrative and explain to them why this particular method is appropriate for this new way of approaching what financial markets are. And when that occurs, I think maybe the popularity of trend following will increase and there'll be greater AUM towards trend following models.
I like this point very much, and I like what the words of Mark Zebrzynski about narrative, his theory, narrative theory. I like it much, and I like the words of Richard, especially when he said it in a previous episode of the great episode of the Systematic Investor. He said that when we look at complex things as complex adaptive systems, and in terms of physics and mechanics of a complex markets, we think that price is really our only guide, and it's non-linearity and linearity of that price which is important to us. And also he said a lot of interesting things in this episode about narrative, and he said that there is a reason why simplicity is good, as opposed to the simplicity is simple. And also he said that very complex structures can emerge from very simple rules-based systems. And I made all these notes because it's really important for me. It's important, I think, to every trader who wants to have investors, at least. And we can say a lot of. In fact, there are a lot of interesting stuff in this. A lot of interesting things we can say about Transform, and we have very big evidence. It's evidence-based structure. So maybe we should do more on this field, I think.
I think the reason trend following, in my opinion, I don't think it'll ever be mainstream really, and that's because, in my opinion, I think people trading the markets and institutions are either trying to predict and profit from predictions, and then on the retail side, you've got the majority of people trying to essentially profit in the short term. And I think because of those two factors, I can't ever see a space for trend following in the mainstream. But that obviously doesn't detract from how effective it is and how much I love it personally. But I can't imagine it ever becoming mainstream, just because I think the markets are dominated by other kinds of institutions and retail traders who are either trying to predict and prove themselves right, or
or profit in the short term.
Yes, but
I can. Sorry.
where are the results of this prediction? We have some results, but that we all know. But as I said, I don't see it's being repeatable for me personally, at least. And where what results, good results of long-term evidence of these predictions, I don't see at least a lot of fonts that are good in this.
So I can just say for myself how I tried to solve it, and I wish that the Mark episodes had came out before I decided to kind of go down the way I did, because I'm systematic global macro, and that allows for the flexibility of narrative. It allows for me to have some bells and whistles, and people ex post can see what the trend was, because good trends will have some macro component that you can attach a news story to and understand why those trades worked out, or what um, was able to drive those things. And that can go for uncertainty in other markets where you're getting whipsawed in and out, and you're able to come up with these generalized themes that do match up with what's people's expectations. Now, it's not a perfect solution. I can say it does have its drawbacks, because I guess it takes me away from a little bit farther away from the crowd here. But it is part of trying to figure out how to build that narrative. I do think that there are solutions. I do think it is solvable. I'm not sure that bringing in, ergodic theory and things like that is something that even an institutional consultant, who's normally who you're going to face to be the gatekeeper to these real money allocators, is going to be familiar with that. I mean, they're covering so many different asset classes. CTA, or derivatives traders, is already one, and then you have all the different kinds of trend followers. So even if you were able to educate, the information take up rate would be in the order of years or decades. I mean, think about how long it took for the idea of crisis alpha to come in. And now with Richard and Top Traders Unplugged and all these guys, we're trying to change it into hunting outliers. It's just in our little circle we hear the echo chamber, but like if you go ask any hedge fund consultant or any allocator, even at a family office, your local family office or whoever, are they going to know what hunting outliers is? So I mean, I think that's quite a distance away. But the onus is on us. The onus is on us as individual portfolio managers, fund managers, to make sure that our clients understand what it is we do, the pros and cons. And then if they do understand that and they get an intuitive feel of how these trends are playing out and how that affects the positions in our portfolios and our systematic methods, then they can be comfortable with those unpleasant characteristics of return curve, or our daily equity, or our Sharpe ratio, or whatever, because um, it's those characteristics that we bear out. I always believe that I'm a product manager first before a portfolio manager, because what I do is I deliver a return stream to my clients. And as long as I do what it says on the tin, it's a much easier story. And then the secondary aspect is to be able to give some intuitive answers that they can write down in their notebook and give off to their higher ups, that will be able to pass it on, because the person you're communicating with needs to also be able to communicate that idea. It needs to be repeated. They're going to have a meeting. You're not going to be in the investment committee meeting. That guy is going to have to defend your position. So you need to be able to make it clear enough, easy enough, have one or two good stories that they can pass on as well. And I found that to be very helpful.
Well, I won't discount the story, and I think that we don't have a good story historically. So, but I will say that many years ago I read this book, and it was the best marketing book I had ever read in my life. And the author followed it up with like two or three more, and these books were just amazing. And I thought these are the greatest marketing books. And a lot of what's been said already, obviously, was in some of in the chapters of these books. So, but at the very end of the book, or maybe not even at the end, he says, one of the best things you can do for your marketing is to improve your product. And I was like, crap, I thought I was onto some sort of shortcut here. Not minimizing the need for marketing and story and communication, but really at the end of the day, that has really been the lesson of my years in the markets, is that, if I would have maybe just improved a bit, that would have had way more impact than some of my attempts at my story or marketing. I think we should definitely rely upon people's greed, and money will flow where the money is being made. Now, when the money is not being made, I need so many explanations. I need so many good stories and due diligence questionnaires filled out, and there's so many reasons I can't invest now. But when the money starts flowing and we get back to the 90s and early 2000s, where the CTAs made more money than the stocks, and obviously the volatility was less because of all the diversification and the risk controls, then I think magically clients will get this education and not even give a damn about a story or love the story. And the story may not have even changed. But I think a lot of it is dependent upon maximizing our opportunities, not using the classic trend following, adding stocks to the portfolio. We're not ready. We're not ready because very few people are willing to let their profits run and take small losses and pay attention to maximizing the opportunities in these markets and hunting these outliers. It's still an industry dominated by being very concerned about the smoothness of the ride, the volatility, the sharp, or any ratio. I don't care for any ratio that puts in there some sort of volatility of the equity curve. How much money did you make, and what is your risk per trade? And so I think that until we get back to that level, we don't deserve more money. We're not going to get more money. We're not going to exploit the benefits of CTA trend following. What is our competition? It's something that makes 8% on average per year with at least a 50% max drawdown. We could not come up with stats that poor if we trade trend following and if we only traded 50 markets. It's not even possible to be that bad with as many markets and the shorts and the CTA strategy and the trend following strategy that we have. So the money will flow. There's no doubt. The history of business is that money goes to the people who provide a better, superior product that's priced fairly. And so it will come to the CTAs. It will probably come after I'm long gone. And people will say, man, this is what Jerry was preaching all these years. Too bad he didn't get to participate in it. Hey, that's okay. Do the right thing every day in the markets and in life. And if I got lucky early on, maybe I won't. Maybe I'll have another lucky period towards the later in my life. But we can't really
You'll have a
time these
state
things.
funeral, Jerry.
We can't time these things, and we just have to be ready. We have to be ready. In 2008, who was saying long equities is very dangerous? You need to diversify. You need to get into commodities and shorts and trends. I don't think there were too many people saying that in the midst of the stocks at all-time highs. Who's saying it now? So who's going to be rewarded with the next 50 to 70% drawdown?
Perhaps one narrative that, in terms of blending classic trend following with other ways of risk managing, has proved to be particularly successful, and is that of Ray Dalio and his all-weather portfolio. Personally, I find that quite inspirational behind the way I interpreted trend following. And though I am more of a trend follower than a blender of revenue streams, his narrative is incredibly seductive. He might be wrong, and I think Jerry might say, well, yeah, he's got the wrong narrative and the wrong message out. But in terms of being able to develop a successful business that is not purely convergent and is not purely, macro and calling out events and making money of those, but has systematic approaches and tries to make money out of events that are unfolding yet not specifically predicted ex ante. I think his narrative and his message and his marketing is quite powerful. So I think he's a good positive example that the trend following industry can draw from and draw inspiration from, and maybe try to sort of mimic and tailor made to their style.
It seems like you have an approximate choice, which is, do you want to be a robust trend following purist and investors come or they don't, or do you want to add some kind of narrative that potentially forces you to go against your definition of true robust trend following in the name of raising assets? And whichever one of those you prioritize will set you on your path, I guess.
Oh, for
Well, I
sure.
think if you prioritize, doing the right thing, and then it may not come to pass, but when it does, you'll actually have something. I think that if you're making these compromises, and especially for CTAs who are, the only way out of this is to show the value of the holding on to the big winners and diversifying like crazy at this stage. For there's some who are still hanging on with assets and still clinging to um, non-traditional ways of trend following, and suffering performance-wise. So I think that's, I guess, a decent business model, because I think not only do the clients, the CTAs struggle with letting profits run. Obviously the clients are going to struggle with letting profits run. So I think I would advocate, unless you have billions under management, if you want to hit the lottery, then wait for doing the right thing to become popular.
It's interesting. I did a study, it's probably 5 years ago now. I took the returns of a lot of different larger brand name trend followers. And what I noticed was that the ones with the most assets often didn't have the best returns by a pretty wide margin. And I talked to some people I know in the industry and said, why do you think that is? And they pointed to the number of marketing people at those funds. But I guess, I think you're right, Jerry, to do the right thing, but it seems like money doesn't always go to the better returns. It goes to better marketing or more marketing or whatever you want to call it. So for whatever that's worth.
Yeah, brand, George. It goes to brand, I think.
I have a different perspective on that. The ones with the big money are the European ones. They have that "I'm smart, we smooth it out" narrative, and by having more assets, of course, that they can hire more marketing people. I don't believe that it would be smarter for them to have a higher percentage of marketing than anyone else. I mean, okay, if you're a small shop, you have one, but if you're a big shop, you can afford 100. I think that everyone still has to run a business at the end of the day. Talking about smaller manager, and okay, to finish that thought, they will have worse performance because they will catch less of that trend. They have less allocation to it because they're using other strategies to mitigate those poor periods, which makes the investors more comfortable. Um, Hence, they're willing to stay with them longer and even ride through that poor performance because on a monthly or quarterly basis, it's not a negative line item. Which, if you do have a classic trend follower, it might be a negative line item for a while or a flat line item, and then you minus your fees, and then it's still negative. So there's still a bit of a hurdle right there. While if you're employing carry strategies or things like that, you will be able to recoup that, and it's much easier to survive until the point where they can catch 50% of the trend. And then when that occurs, the classic trend followers outperform, and then people are questioning, like, yeah, okay. And then if you add compounding potentially over time, multiple of these trends happening, the classic trend followers can compound their winnings, giving them a net overall higher um, cumulative return on the whole data set versus a more stable quarterly or monthly return. For the small people, I think what you were saying, or what you were saying, kind of going back, like, where you have something robust, are you going to be able to raise money? I mean, for me, that's a real business concern. I'm younger, I think, than Richard and Jerry for sure. I have newer product and have to think about how to position myself in a marketplace where I believe that what I'm saying today is what I've experienced. So being able to wrap that with something that still maintains a positively skewed return distribution, tailoring it the volatility to a point where the clients that I do have, it's enough trend following for them, if that makes sense. And that it will, if those drawdowns, the length and the depths are something that they are willing to accept, given the narrative. Now, is that the optimal amount of trend following? Probably not. But is it the good amount that allowed me to have a fund and continue to try to carve out a niche in this world? The answer is yes.
But the problem I find, we always talk about smooth returns by convergent systems, but I think that's the illusion. I mean, yes, we've had smooth returns since 2010, but if we go back over a long-term track record, and I think the ultimate test of robustness is the long-term track record. Why don't we see these convergence styles existing over a 30, 40-year track record? And that's because the risk weakness is exposed over the long-term track record, where you've got these very unfavourable market regimes where convergence absolutely fails, and because of the lower sort of risk mitigation that's present within the convergent systems, they head towards risk of ruin. It's not like a trend follower over a 30, 40-year period that goes through these periods of protracted drawdowns. These guys, they go off the face of the map. And so an investor talking about, well, we can offer smooth returns, this is the illusion. It's smooth returns while the regime is appropriate, but turn that regime around, and this is where timing comes in. I think it's a disservice to actually even consider convergence.
Here, here. I've used that recently. I copy Richard so often, and because I agree with that so totally. As a risk manager in life, why would you put yourself in that situation? I think another way to approach it is to challenge investors. Are you tough enough? Can you do the right thing? Can you let your profits run? Look at all the money that you didn't make because you weren't invested in this, or you didn't handle it the way that the classic trend following with massive diversification and shorts handles things. And challenge people. Maybe this is not meant for you. Maybe you can't do this. Because you know what? In order to get them in it, they have to believe it, and sometimes they have to be shamed into believing it. Because they're shamed by the S&P. Oh, every day, people are converted into believing that stocks are going to go up. You can't predict. Find the cheapest index and just hold on. And if it goes down a lot, buy more of it. And it's difficult to do, and they have a hard time doing it. But when it goes right back up, they're like, darn it, I learned once again. I keep making the same mistake. All my friends are hanging in there. I need to be a believer and a convert into this type of thinking. And so I think taking lessons from, but the root of all of that belief and that conversion lies in the fact that it makes a lot of money, and they like the money. And eventually the tables will turn, because we'll get out of this period where the trends were not allowed to do their thing, and we'll get back to a period where the money will flow to the people who are making the most amount of money, irrespective of big profits turning into small profits, big profits turning into losses, and high volatility, and all the negative characteristics. Those characteristics are more negative with the S&P 500 index.
By the way, I have told you before, I had one client from Silicon Valley, United States, and he said that he understood how, I think he's a smart guy, and he understood how trend following works. Maybe I wasn't very clear, I don't know. But he invested money, and after, when he saw 2% drawdown, he performance, and in a 2% drawdown, when it was 16% performance, 16%. He said, it's so not good situation. I don't feel comfort. It's better for me to be passive in SP 500 than to handle this 2% drawdown. So
No, I think that's interesting. That's exactly kind of the point I was going to make. First of all, the world runs on convergent trading. Let's not discount that. What is the entire asset class of fixed income? You create a bond, you get it back at par. The par is the intrinsic value. That's the mean value. That's a conversion system. FX carry, rates. So much of this world is done that. Even if you think about like, okay, corporate credit, the guy who's got the bond shorted an option and gave the long option to the equity guy, who's then going to pass that on to the person who eventually IPO'd. Um, and then you think about uh, how do they maintain this negative drawdown narrative themselves? Everyone else lost money. It's okay. When the S&P 500 goes down, everyone has pain. We can all go to the bar. Rounds on me. Yeah, it's down. It's a bear market. Economy is bad. It's fine. Let's have a drink. That cannot be said for divergent trading, which can bleed for a while because you can have choppy markets. Because you basically are trying to replicate like long volatility, and they can't go to the bar and do that. They won't feel comfort from their friends. And again, it goes back to this narrative idea of what lies people tell themselves. It's not the objective truth, but it's not career risk. Your boss will understand that the economy is down. We've been hit by some kind of new XYZ thing, and that's why the markets are down. It's okay. Everyone else is down. Just be 1% less down than our competitors. We can still sell this. It's fine. But if you're holding a trend follower who's down, everyone else is up. They instead of giving you that 5%, they put that extra 5% in the S&P 500. That's up. Now what? You have this, massive differential of spread between your performance and your peers' performance. Well, you're fired.
Have
The
Clubhouse
interesting
too.
thing is we were talking about, Stanley Druckenmiller and people like that talking about concentrated strategies. But, when you look at Berkshire Hathaway's performance, you realise that, it's been 3 stocks of Berkshire Hathaway, the outliers in his entire performance record, that have been responsible for his amazing success. Coca-Cola, and there's a couple of others. So, they'll say on one hand about, the benefits of concentration, but, they'll get all of the benefits that we get from outliers and they'll totally discount that and say it's not worth anything.
Yes, well said, Derek and Richard. And I believe the psychology of the masses is the antithesis of trend following. I believe you guys agree, right? We talk about convergent trading, buy and hold, have penetrated crowd psychology, which what appeals to, let's say, greed, laziness, and victimhood. We just talk about an easy fix. So, I believe trend following is hard and it is against human nature. And what I learned from trend following is, it is life. Think about it. How many people would tell you, say, hey, you got to go learn how to embrace volatility, embrace changes, right? How many people can do that? And why the school system never teach children? So, on the other hand, I believe it's good for the trend followers because not a lot of people are doing it. So I remember I heard from Moritz Schubert. He said, oh, if everybody is doing trend following, then we won't be able to make money. Don't you agree?
No, I actually don't agree with that because I think any divergent model actually uses the principle called positive feedback. This is different to convergence. In convergence, you can, with increased competition in the convergence space, you eat the arbitrage available from that alpha. But within divergent models, the positive feedback of more participants doing the same thing actually accentuates the outliers. So I would tend to disagree with that. But apart from that, Lulu, totally agree with everything else you say.
Yeah, I remember having that discussion a while ago about the concentration when it comes to diversion and conversion in that sense. It's quite interesting to see, especially since the environment right now, it's much more concentrated on the conversion side. So I'm pleased, or I'm very curious to see how the next few years and in the long term things will plan out in terms of strategies and stuff.
The way I'm thinking about overcrowding a lot of years, and I don't have an answer for this. And it will be very interesting for me to know opinions of somebody about this, especially Jerry and Richard.
Yeah, look, the whole principle of an outlier is based on the fact that we get synchronous behaviour. So, in periods outside of outliers, you get different participants doing different behaviours, and the impact of all of their different behaviours basically it dilutes signals, or you find that. It tends towards equilibrium when you get lots of different pressures in the market from different participant behaviors all sort of acting in concert. But when you get synchronous behavior, you get this positive feedback, this what do you call it? It's an amplified behavior because everyone's doing the same thing. So when you start getting into market extremes where the market's tanking, you get the massive short squeeze occurring where people that have been trading long, holding until it gets unbearable, and then when they try and exit that position, they adopt synchronous behaviour to what the trend followers are doing. They're all doing the same thing at the same time, and that creates these price extensions or from positive feedback. So when you look at there's positive feedback in the tail regions, and there's negative feedback in the bulk of the distribution. That's what creates a different sort of form of distribution of returns.
That's an interesting one as well, because that makes me think: do we want systematic trend following to be more mainstream? As in, would it impact, if everyone was doing trend following, would it impact positively or negatively kind of the returns that previous trend followers were getting previously?
Well, you'd have central banks having to step in and being much more interventionist if everyone was a trend follower, because people that were just following price, and if all of that behaviour was the same, and we were getting this massive price extension or an asset bubble forming, you'd have to have central bank intervention coming in with convergent methods to try and neutralise that volatility.
I think it would start to look more like a frisbee, almost jumping from one extreme all the way to another extreme, just because of because of the positive feedback in that sense. That's my opinion.
But is it even possible to have everyone being a trend follower? I mean, the financial instruments are there not because of us, not because of speculation, but to hedge for actual products. I mean, we trade futures on the other side of people who actually are delivering goods for the markets, and these guys are definitely convergent, not divergent. If I mean, if your question is, suppose every speculative trader is a trend follower, I don't know it would be any
It would
harmful
stuff the
for us.
markets, Bruno, because you need a buyer and seller for every transaction. So if you've got this dominant sort of divergent players, the other side that would have to sort of respond to that, they'd be getting all of the benefit and price. You get these massive liquidity gaps occurring if everyone was divergent.
But I think in reality, there's always different groups, different philosophies, different people with different mindsets. So in real reality, you might have a dominant group, but you always have smaller groups that think differently. I don't personally, I don't think there will ever be. Okay, I don't want to ever put never or into it, but it's very hard for people to be in the same place. But it is obviously a possibility to have the mainstream think in a certain way, but in terms of everybody, obviously that's almost statistically impossible.
But if what they say is right, and 95% of the participants are convergent, I think we can accept a bit more divergence in there to sort of get some more of these outliers happening. It's interesting. If you look at the if you look at the sort of the long-term track record, you can definitely see where central bank intervention, convergent participation, etc., it certainly does suppress volatility. And you saw this post 2010. Everyone was buying the dips, selling the tips. There was this massive fueling sort of increase of convergent players. You couldn't lose if you adopted that philosophy, because not only is it something you can understand, but also it was being backed by central bank intervention and regulatory policy. And this too big to fail sort of scenario, you couldn't lose. So it's easy money. But the trend followers are there scratching their heads, saying, "For God's sake, stop intervening in the market. Let it do what it wants to do." And we were suffering along the way with these sort of nasty drawdowns. But at least we didn't go out the back door. It's been an active session, Jerry, this one.
Yeah, George left. He had to go. He has little kids, I think. But before we got a chance to dig deep into all the tweets that you guys had between each other. But I didn't know if there's anything that stood out in that that you wanted to mention. He was focused on the turtle systems, and if the turtle systems quit working, then were they robust? I think at one point he says, if a system quits working, can it be robust? And I thought, well, in my mind, robust just means, do you have a sample size? And, one entry, one exit, a stop loss will give you a large sample size. And the turtle systems were short term, so the sample size was large, but it didn't go back as many years as it does now. But anyways, I guess he was wondering whether the turtle systems, if they went bad, then what about the new long-term systems that we're all using, longer terms? Doesn't that mean that they can go bad?
I remember you were talking about this, and I remember you said that you were trading short term back in the 1980s, but when you revisited that with your longer term systems, you found that the longer term systems would have been valid from then right up to current day. So they've always been working. It was the short term systems you said were more specific for that particular environment back in the day, but now they're probably suffer from too many whipsaws. If you applied those same parameter sets you applied back in the 1980s.
That's right. So that was the good news for us, is that we weren't coming to this crisis point where we had to get away from short term and find something that was working more recently. It's that when we applied the longer term parameters, they worked better than the short term stuff. But the short term stuff is better because if you can make about the same amount of money with lower drawdowns, everyone should take it. It's just that when you find something that's great and it has larger drawdowns, I'm hesitant to fiddle with it and mess with it and add parameters to it too much. So and I think another thing with the long-term stuff, I think a lot of people would say that we probably won't get to a period where it will be tempting too many people to use trend following because of the human nature aspect of it, because this whole desire to not let profits run is embedded in us. It's such a struggle for people who do it to even do it. And then the biggest players in our strategy don't do it. So they don't want to do it. They're matched up with clients who don't want them to do it. So it's a beautiful marriage. It's just they don't make as much money, and they've suffered recently because the trends went back to being big. Um, all the data that we saw from the prior to the past 10 years would say, hey, hold on to those long-term trends. And then finally, they reemerged again. And so hopefully they will continue. But I think human nature and, it was a revelation to me as well and it makes sense to me. I agree with you that really our biggest problem and the need to go longer term is not due to the trend followers. It's due to the amount of convergent trading that's screwing up our trends and creating drawdowns and creating volatility, only to see the market return to new highs more often than not.
Exactly.
I do think we have we don't have enough time to get into it, but many minutes ago, I was jotting down all these notes, and I do think that it would be something good to bring up again later. Of course, this idea that when I'm listening to people talk about diversification and outliers, and the need for more markets and more smoother returns, it is sort of, I do get confused a bit to like, okay. Then why am I trading crude, West Texas and Brent? I think sometimes I feel very contradictory that I'm looking for all of these different markets, but then if I kick Brent out of my portfolio, there's going to be a big Brent move one of these days because it's going to be some unique economic circumstances with Brent, and I'm going to be rewarded for trading too much crude oil almost every day of my life until that one big outlier comes. And so I'm confused about how to walk that fine line on hunting outliers exclusively, and that's the reason for diversification, versus also doing back test based on trying to find markets that give me more diversification.
I think there are two forces at play, Jerry. There's outliers. So when you talk about Brent and crude, we know that outliers can exist in crude, as they did back in March 2020, but they didn't exist to the same degree in Brent. So outliers are sort of independent. They're not necessarily correlated, but we're fighting also against the adverse impacts of risk, which is correlation. Too many correlated things in our portfolio. So, you know, I think there's degrees. Whilst correlation should be a secondary consideration for us, we should always keep it in the back of our mind, and that's why we don't, for instance, trade, thousands and thousands of stocks in our portfolio. We've got to have sort of a more balanced representation to try and achieve this uncorrelated ensemble. It's not the uncorrelated ensemble is not for the outliers. The uncorrelated ensemble is to prevent everything going to one and finding that all of our small linear sort of losses suddenly add up to massive non-linear adverse events for us. So that's where the risk weakness comes in our portfolio. If we are too aggressive, we do have to address correlation, even though our prime consideration is outliers, as far as I'm concerned.
Yeah, and there's even a third, I think, dimension, Richard, which is an extension of what you were saying, and it's probably what Ioannis also was inquiring about with his question on correlation, how you measure it. It's just whether by combining all these different independent trades, you can achieve a revenue stream that is more robust than the sum of the underlyings. And you're not doing that through volatility targeting. You're not doing that as as an afterthought. You do it at the outset. You're trying to combine revenue streams in such a way that you have stable returns. And of course, this is a very strong preoccupation of mine and a very strong point of focus for me. But I think is even an extension of what kind of correlation you're looking at. So it's difficult to reconcile, I think, yours and Jerry's philosophy with this last point, because for you, and Jerry said it very eloquently, Brent and WTI can turn into an outlier tomorrow morning for all we know. Whereas if I applied my sort of filter, I would see that they actually provide 90-something% of the same revenue stream. So they should lead to different decisions. But it's a very interesting topic and something that I'd be very happy to.
I think I'm sorry. I think that it's okay to do so. Trade high instruments that high historically very high correlation. It's okay if you have a huge amount of money. If you have enough money to do such a diversification, and if you have 100 markets in your portfolio, I think it's okay to have Brent, crude, and heating oil in this 100 market portfolio. But if you don't,
wouldn't you be diluting, like basically then you're not using effectively your risk capital. If you have, for example, like, X units of risk capital to deploy, and you choose to deploy it into very correlated markets, then effectively you're taking the same bet twice. Whereas if you took two different bets, two uncorrelated bets, you would have a better outcome in the end. So that's why I'm also very interested in this particular question, like, about diversifying, and what exactly are you achieving by betting on essentially the same revenue stream.
You can catch the next outlier. And that's very true, actually, if you think about it, because you don't know which instrument between Brent, WTI, or stock ABC is going to turn into an outlier. So they have a very valid point, which is difficult to reconcile with the way you, myself, and Derek probably think about, portfolio management and construction.
That's right. It's not the same revenue stream. It's potentially a different revenue stream because these revenue streams are dominated by the outlier. And I've said before, twice in my career, I made a lot of money, at least twice, on heating oil because it doubled, and crude. There was a freeze in the New York harbor or something in 1984. Feb heating oil 84, D's heating oil 1990. I made 30% in 1990. I made 30% in December. I made 30% in that heating oil trade, and that then heating oil went back to being 95% correlated to crude, and then um, someone reminded me on Twitter a few years ago. They were like, um, in this type of conversation, they were like, and yes, and it matters even less the more markets you trade. I'm like, oh yeah, that's true. That's true. I trade so many markets now that if I am making this mistake on trading too much crude or too many petroleum products, it doesn't even move the needle. It's not going to really mean too much on a daily basis. You lost a little bit more in January because you didn't pay attention to the correlations in energy, but 1 month out of your entire career, you had a huge outlier because you did that. And I think that is a good trade-off.
Yeah, I tend to think that what we're trying to do. So ideally, in a theoretical world, we'd just like to catch outliers. So 100% of our trade efforts, we'd love just to be outliers. Instead of the 5 to 10% of our trade distribution, we'd like it 100% to be outliers. But inevitably, the 90% of our trades are the whipsaws and the sort of what I regard as the noise of the equity curve. The vast proportion of it is noise. So what we're trying to achieve with diversification is to diversify as broadly as possible with as small a bet size as possible. But, and this is the key but, be very restrictive in what trades you want to take. In other words, Jerry might use a 100-day look back on his models. What that means is that he might find on a single return stream over a 30-year period, he might find that single return stream only contributes about 10 or 20 trades over that entire 30-year period. Too many trades contribute to the noise of the equity curve. So you want to be very restrictive. So in other words, you want to set your thresholds or the look backs as the means to ensure that you're targeting that tail region of the distribution of returns and you're not participating in the bulk of the distribution of returns. So what that means is that at a return stream level, you've got a very low sample size, but with your extreme diversification, with very small bet sizes that allows that extreme diversification, you're really focusing on trying to get as many of those tail events into the distribution as possible. So that's the key. There is selection involved. So you don't sort of jump into every trend. You wait for these extreme trends that by definition are sort of exotic, much bigger than what the normal distribution implies. So you're not sort of getting sort of every breath of wind. You want to get those cyclones or those typhoons that really give that positive feedback and turn into these material events.
And to some degree, we don't have this constraint on capital because we we use leverage, and the more markets we trade, we can continue to trade. The overall risk budget can be a little bit bigger, and so you don't want to go crazy with that idea. But was trading 5 units in this last year. Now I've added 50 markets to my portfolio. I'm up to 170. Okay, what am I going to do now? Go from 5 to 6? No, but I'll trade a bit larger, And so this is kudos to me, right? Because I should be able to. I definitely trade larger than if I had 20 markets. So keep going and make it a little bit bigger, don't get crazy. But this is the issue that people faced last year with all the grain markets going up. And they were all correlated and they all went up at the same time. Every day they would be up. And then you'd look around and, wheat made a bit, meal made a bit, and bean oil, rapeseed, canola made lots more. So when things go up, they're very highly correlated, but that's not indicative of some of the fact that some might have huge monster outliers. So you can't sit back. It's risky to sit back and say, I'm covered. I don't have to trade everything in that sector. And we're saying, oh, yeah, you kind of do. Well, do the best you can with your capital and with the liquidity and your AUM. But yeah, that's your goal, not to have the sector covered with with enough of anything, because it is in the sector. It does look normal most of the time, and then all of a sudden, it's not normal. Okay, I'm gonna have to say goodbye. You guys can keep going if you like, and it's been fun. And we'll pick it up next week. Thanks, everybody.
Thanks, Jerry.
Thanks, Jerry. Thanks,
Thanks, Jerry.
everyone. Bye.
Thanks,
Thank
Jerry.
you. Take care.
Thanks.
Bye.